Let's say you're a 1 billionaire. All you have is 1 billion. Your tax on this billionaire's tax is $50 million. $50 million. What can you do with $50 million? Just because it's a billionaire tax today doesn't mean they won't come up with another tax next year and the year after that, and a federal tax. Most billionaires are not keeping their money sitting around in cash. They're going to be having invested in short-term and long-term investments. If they have to pay all of a sudden a 5% net worth tax, they would probably have to liquidate a lot of their positions in order to pay that tax. When they liquidate that position, they're going to have to pay capital gains and other taxes on that. And at their rates, both California and federal rates together, they're paying in the neighborhood of 54% of their income is going to be taxed on that. So, in order to pay, if you will, a 5% total wealth tax, they're going to have to liquidate in the neighborhood of 11% of their wealth in order to pay that tax, because it's going to generate additional tax just in liquidating it. That sell off is going to create a liquidity crisis. It's going to create a loss of investments, a depreciation, asset values going down. Even still, they're going to be taxed on it. Let's break it down a little bit. If you're a millionaire in California, you're already being taxed at over 50% of your income that year, because you have the US taxes, which you're in top tax bracket, which would lead you up into about a 41% tax rate when you include other taxes that kick in at the federal level, plus a 13% tax at the state level. There may be taxes at the city level. And then they want to layer another 5% tax on all your wealth, which is not just the income, but all your wealth. And that is a staggering amount of money. So, and they wanted, and if you're you're basically working for the government at that point, and you're not allowed to keep your wealth because they feel the government's entitled to a cut of all your wealth, not just the income that you earned it. Think about this. The wealth tax in California is a tax on wealth which has been derived from post-tax dollars to begin with, and they want to tax it again, as well as the profit that you've made. The whole thing is just not fair. It's not equitable. And what's really concerning everybody that should be concerned is like today it's the billionaires, a one-time billionaire tax, but the state will always want more money. So next time it'll be a tax on the 100 millionaires and the 10 millionaires. Pretty soon it'll be the 1 millionaires, and pretty soon it's everybody. You have to fight against the principle of what's going on here. That alone, plus the fact that already the billionaire tax has caused, according to Chamath, at least half the billionaires in California have already left in expectation that this is going to happen. So, when you leave, you're never coming back. They're losing future tax revenues. So this billionaire tax is pulling money into one year, but it's stealing from the future, and it'll cause bigger issues in the future for California. And I think also, especially billionaires are going to look at moving when they move their residency and their base of financial interest. It means they'll be moving companies and businesses out of the state, and that affects people that work for them and the companies that provide services to these people. So there's a real ripple effect with these people moving and leaving the state. Here's the issue. There is a point at which people refuse to be taxed further, and they will remove themselves from taxation by moving to another place. I mean, this is what Europe discovered back in the 1990s. It became quite the rage in Europe. All the countries decided to tax wealth, and they decided to tax the wealth of other people. What do you know? Their people moved out of their states. They moved to countries that did not have a wealth tax. And the other thing that happened was that the tax authorities found it was very difficult to tax the rich. They were spending an inordinate amount of money trying to discover the wealth. And then it got all tied up in legal cases. And the net result was that very little additional money came in. I mean, here in California, they're expecting to get another $100 billion of revenue. Well, you're not going to get that being challenged in court for a long time. And you have the concerted efforts of many billionaires to thwart and undermine the legal system and the legal court cases. I mean, it just will not result in anything except talking points for politicians. It's absolutely ridiculous. And it's not realistic. I mean, a government and the people need to realize that entrepreneurs and industrialists are the economic strength of a state. and that if you chase them out, you're chasing out the economic strength of your state. I think it's really coming to a head in US politics. If you're a wealthy Californian and you'd be affected by this tax, or if your wealth is up in the millions, they're going to come for you. And how do you protect yourself? Well, California is known as the most aggressive state in the union for going after its residents on paying taxes. It is by far the most aggressive. It's more aggressive than even the federal government. And one of the ways we saw this, it's called the Bragg case. This is about a California person, and he moved to Nevada and he refused to pay California taxes. The California Tax Board, called the Franchise Tax Board, the FTB, came after him and he filed suit, and it was heavily fought. And it kind of came up with what were the attributes that define whether or not somebody is actually a Californian resident or not. And they basically decided that while this individual, Stephen Bragg, had moved to Arizona, he had not really left enough of his California connections to treat himself as a non resident. And the Bragg test is kind of the defining test in California residency audits. And it involves looking at three major areas: basically, your physical presence and property; secondly, your professional activities; and thirdly, they're going to look at formal registrations. Let's break it down a little bit. So, if you still have property, land, even only a second home in California, they can use that as a basis for coming after and taxing your global income. So, if you want to actually leave California, you don't like this tax and all the other things that aren't going right in that state. In order to leave, you have to genuinely leave. You have to pick up and move your home to another state. You have to take your family with you. You have to register your kids in schools in that other state. You need to re-register your cars in that other state. If you have a professional license, let's say you're a CPA, you need to get registered in the new state. You need to move your bank addresses to the other state. So typically, let's say you have an account at Bank of America. You want to change that bank to be let's say, an Arizona bank or a Nevada bank, and you actually have to have the mailing addresses changed there, and then that way you're considered as having a Nevada account. Now, secondly, if you have any property, land, etc., you got to move it. What about if you own a business that works in California? You might not be able to move it very easily, but you still may retain a certain level of California income, even though you are a non-Californian for residency purposes. But you want to, as much as possible, move your assets. You can move companies. You can re-register them in another state, but they actually have to operate in that state. They just can't be on paper only. So you have to be thorough. I knew a person, represented a person who was living in Argentina and had lived there for some period of time, but he used his parents' California address as his address with different financial institutions. So all his 1099s got generated to the California address. And then pretty soon, California was coming after him. They wanted to tax all his income. He said, "Hey, they can't tax my income. I'm living in Argentina. I don't have to pay any California tax." That's the way he thought about it. The way California looks at it is this way: you held yourself out as living in California. That'd be the key phrase here. You held yourself out. He used California as mailing addresses. His address of reference was credit cards, banks. They were all based there. And because you represent that and you enjoyed the benefits and privileges of being in California, you owe taxes in California. So there are several states that are very aggressive about tax residency. And California is one of them, Pennsylvania. There's a number of states you'd be surprised that really are aggressive. So if you are living outside of the country, or if you're living in a state, you definitely want to make sure that you move your mailing addresses to the state you live in or to a non-tax state. So you need to aggressively and decisively and definitively uproot yourself from California if you want to avoid the California billionaires tax, or let's call it the future millionaires tax, as it will eventually become.